Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. I am your host, Chris Seveney. Today, we are going to touch upon 5 myths about passive real estate investing debunked. So I see a lot of information that's always flowing out there about passive real estate investing. I see ads on Facebook, LinkedIn, Instagram, Twitter. I see people posting on Bigger Pockets, all this hoopla on passive investing. And to be honest, 90% of it is full of BS. And I say that because in today's environment, today's world, I find everybody is looking for instant gratification, that get-rich-quick scheme. And because of that, I think it leads to a lot of misconceptions on passive investing, which leads to why it's misunderstood. And, I'll share some personal stories and observations and some of these common misconceptions throughout this episode to hopefully provide you some additional insight into passive investing, what it is, what isn't. And again, we're going to touch upon these 5 myths. So let's dive in and start with myth number 1. Passive investing requires zero effort. Passive investing can be hands-off, but it still requires effort. What does that mean? Upfront due diligence. I cannot tell you how many times I've heard from people who didn't do any upfront research and due diligence. And I'll start with the first thing to never, ever, little Boston accent there, do if you're going to invest passively. And that is listen to a friend, a colleague, coworker, somebody online. I don't care if they have a podcast and whatnot. Do your own research. So share a few stories. One was, I'm in note investing, and somebody wanted to invest with somebody because they saw online they had like 1,000 YouTube videos and they're all over the place online and they sound so reputable. And person asked a question in a Facebook group, what do you know about this person? And then somebody posted to a link of a website where it has all the lawsuits against this person. And the response from the person who asked the question is, I can't believe this. This person, has such a good social media presence. I can't believe and they sound so intelligent that I can't believe this. And I'll tell people, just because somebody has a big social media presence means they're a good marketer. That's all it means. And I could tell you, again, going back to information I've seen, it's all the same recycled content, just said differently. Another, I'll say, on upfront due diligence is people don't understand what they're investing in. They don't read that private placement memorandum or the offering to even understand it. If I'm investing $50,000 in something, I'm going to spend $500 to have an attorney review and kind of tell me, what's my risk? What's involved? Share another example of a fund that I'd say is similar to ours. And they were giving returns that were slightly above ours, which I'm like, okay, most people, in a note fund are between, call it 8 and 12%. Then this person bumped up to like 15 to 18%. I'm like, it's, I'm scratching my head on how they're getting there. But when they bumped it up, they turned around and raised, 10, 20, $30 million plus from people all at the same time, because everyone's just looking at the shiny object of, this is what the return I'm going to get. This is what I'm guaranteed. You're not guaranteed. That's a target. And people throw out high numbers It's no different than going to a car dealership and saying, oh, you can get into a Mercedes for $30,000. Yeah, when you get there, the $30,000 is, not the vehicle you want. It's the inverse with some of these returns. If all the moons align and everything happens exactly the way it should, maybe they hit that. That's how some operators operate. So you need to do your upfront due diligence. You should be able to articulate to a friend exactly what it is you're investing in and what the risks are. And that person should know nothing about it. So think about walking up to somebody and explaining to them first time how to do something. If you can do that, then you're ready to invest. If you don't understand it, you're not ready. The other is understanding, again, that due diligence process of, vetting the sponsor. Google their name, Google lawsuit, Google their fund. What's their experience? The way I've explained to people is, I've got 2 kids. If you're hiring, we've never had to hire a nanny, but if you were, how would you research that person? Would you just take their resume and say, oh, okay, great. Would you listen to a podcast that they're on and say, great? No, you're going to really dive in and understand because, for most people, for me at least, my kids are the most important thing. And you should, basically treat your money in a very similar fashion. Now, of course, kids are much more important, but you get what I'm going to mean. Okay. Let's jump to myth number 2. Spent a little bit too much time, I think, on myth number 1, but that's okay because I think it's really important to do that work up front because everybody who ever loses money skipped step 1 in a lot of instances. They didn't understand what they're getting into. And number 2, you need a lot of money to get started. Passive investing is not only for the wealthy. It's not only for accredited investors. I'll share again. We have a fund open to accredited and non-accredited investors that you can start with $5,000. And we've had people who started with $5,000 and say, oh, I get 8%. I only get $38 a month. Where are you going to get something better? You can go put it in Bitcoin. You can go put it in the stock market. You got to evaluate the risk return, but you don't need $100,000 to get started. For me, I've spoken to a lot of people who want to invest in funds and continue to grow and understand that due diligence process, and paying $5,000 to get into a fund and see how it's managed, see how it's operated, see what you like, what you don't like. To me, just that knowledge itself, and hopefully you can, should continue to make some money on this thing. It's like free education. Also, these smaller amounts allows you to diversify between funds. And when I see a fund with $100,000 investment, yes, I'm an accredited investor, but I don't want to put up, if I have $100,000 to spend, I don't want to put it all in one fund. I'd rather put 10 funds at 10,000 or 5 at 20 because you need to diversify. But if you have 20,000, there's plenty of opportunities out there of funds, and they're not just real estate, they're everything. Our original broker dealer, Dalmore, I think it's dalmorefg.com. Go to their website. You got all different types of offerings. You can invest in racehorses. You can invest in hamburger flipping machines. You can invest in short-term rentals. You can invest in notes like our fund. You can invest. There's so much out there. A lot of them are $500 or $1,000. Now, some of them may go belly up, but that's part of investing as well, which kind of leads to myth number 3. It is risk-free. Passive investing has risk. Multifamily investors have seen that over the last several years where, I think recency bias was, 4 years ago, everyone was getting, nice, fat, and happy off the returns in multifamily. And you didn't even have to manage an asset. You could buy it and just do nothing with it and sell it 3 months later and make money. That has changed. The interest rate environment and actually managing the asset. Some people are good managers and still deals go bad. Some people are really poor managers. Deals have gone really bad. Original investing, no different. It needs a balance, risk reward. People who invest passively in our fund, expect us to manage it properly. And one of the ways we target and focus on that is balancing and diversifying our portfolio. Performing loans, non-performing loans. What do our performing loan portfolio looks like? What's our non-performing portfolio look like? That's a way to mitigate risk. If it's one asset, you're sinking or swimming on that one asset. You have 50 to 100 assets. One goes bad, really shouldn't have a major impact on that opportunity, that fund. Other mitigation tips and things we look for is diversification can mean many different things. It can mean the asset class, it can mean the location, it can mean the asset type. What I mean by that, I'm not buying all my notes in Tampa, Florida. We're in 20 different states. We have performing, we have non-performing. We typically stay within the single family residential space because that's where we've got a lot of experience. Yes, my background is in commercial real estate. We could do that as well. It's got a higher price point and doesn't allow me to diversify. And that process is, vetting. If you're investing passively or actively, have a vetting process and understand when you're buying something, have the end in mind. What's your end goal? So I just wanted to share, it is not risk-free. And if anybody ever guarantees something, it's not guaranteed. I see all the time bigger pockets and a Facebook group about quote unquote gator lending, 20% return guaranteed, pay you back in 30 days. Well, the only way you can guarantee something is if I already have it. And if you need to borrow money for 30 days, it means you don't have it. So how are you going to get it back? So anybody who guarantees or is pushy, run, don't walk, run away. Another is myth 4. You lose a lot of control as a passive investor. Now, do you have as much control? No. You're more passive. You don't have say in the investments, but you have a say in what you invest in. You want to select the right vehicle that can give you different levels of control. For example, I'm a mortgage note guy, or rental, say you're buying a rental. You can be very active, which is you manage a rental, you lease it up yourself, you do everything. Or you can be more passive you hire an agent, you hire a property manager. Notes are the same thing where you can buy performing notes, put it with a servicer and have a borrower on ACH. Very different than self-servicing a non-performing loan. Invest in a REIT, very different level of control. Invest in a fund. Again, different level, but at least you control what you invest in. I think as part of the control process, what plays into that is transparency. How transparent is the fund? And it really boils down to me, I think, how reputable is the sponsor. There's a sponsor I've seen recently, actually interviewed this person on a podcast and gave me really bad vibes from the start. And person didn't really provide transparency and all their answers were very fluffy. And this person was out there raising lots of money for multifamily syndications and buying shitty properties in the ghetto and paying very low cap rates for them. Many of those deals, all the investor money's since been lost. They're being sued. And not only are being sued, but when they lost these properties, they never even let the investors know. They didn't even communicate. They're off to raising money on their next deal. They didn't even tell the investor, oh, by the way, your money's gone. How would that feel? I invest and I want to know what's going on, good, bad, or indifferent, because I make decisions based on the information I have. Let's say you were going to put a small addition on your house because maybe an in-law might be moving in or something. And you're in a fund that has $50,000 coming back, or you think coming back in 6 months. And nobody tells you otherwise. So okay, you ask a question. Yep, everything's going well. Come to find out, the entire thing was already lost. Have a big impact on where are you getting the money? How are you going to do that? Now you might have to finance it. Now you might not be able to do it. I don't think people, these sponsors, understand the real life impact this can have on people by being a jerk and not communicating. Now, one of the benefits, I think, of traditional investments like stocks, mutual funds, you have minimal control. You have more control because you can get in or out, but you can see on a daily basis how it's doing. If you invest in if I invest in Apple, Microsoft, I can go online and look at it. Wow, which reminds me when I used to invest in stocks when I graduated college, you didn't see things online. You actually had to open the newspaper and go to the back section and see how your stocks were doing. Oh man, don't miss those days. So understand that, you lose some control, but you don't lose all the control. The last myth is passive investing is just about real estate properties. And this goes way beyond rental properties, as we mentioned. There's mortgage note investing. There's oil and gas. As I've mentioned, there's companies you can invest in. There's, I've seen some for sports cards. I've seen some for artwork. I've seen some for horses. Again, Miso Robotics, which is the, flipping burger machines, which pretty cool in my mind. So, of course, mortgage note investing, which is tied to real estate, but you're not investing in real estate. And each one of these, when you look at it, provides a different alternative. To me, mortgage notes can have more predictable cash flow, but lower maintenance. You can diversify the properties, but you don't have the upside of owning a piece of real estate and get that equity build. So there's pros and cons that you have to look at and measure the risk. It boils down to what you want to invest in and what's your goal. If you're looking for an income play of, for me, I call myself a goat getting old and tired. I want the lazy river if I go to the water park. I just want to, I don't want to go up and down on all the crazy rides. That's not what I want my investments to do. I like the lazy river that just goes, nothing exciting, but guess what? It's predictable or more predictable than the others in regards to targeting an income stream that I can count on to allow me to make other decisions. Unlike what I mentioned earlier, some of these higher risk investments that might be better returns, but you could have gains, you could have losses, and it's a lot more challenging for me, maybe for you, to predict outcomes and understand, if how you plan for that money for the future. So, hope you enjoyed this episode of Creating Wealth Simplified podcast. I do just want to, lastly, before we wrap up, touch upon quickly how to identify opportunities in passive investing, because that just popped in my head. Chris, you're sharing all this information. How do you identify opportunities online? This guy, Alexi, his last name is like Churn. I can't pronounce it. I apologize, Alexi. Provides a lot of great content on passive investing opportunities. Bigger Pockets, Passive Pockets, 506c Club. There's investment clubs out there who are not sponsor driven. They're investor driven that can provide content, information for you to get started. And again, I recommend networking, leveraging those resources, seeing webinars, podcasts, talking to investors who invest in those offerings, but also understand it's still, you need to do your own due diligence. You want to make sure also, talk to people about what are some of the red flags that you've seen or, based on your experience. You talk to somebody who's been passively investing for 10, 15 years, you're going to have a lot of red flags. Unrealistic returns, staff, is it a one-man show? Is there 5 co-GPs on the deal? Many different avenues. What's their experience? Did they just get into real estate 2 years ago? Many different things that can pose some red flags. Doesn't mean you should invest, just means things that you need to evaluate. So I hope you enjoyed this episode on the top 5 myths of real estate investing debunked. We go through. If you have any questions, feel free, please reach out. I can't emphasize enough the value of having passive investments for building long-term wealth, because it allows you to do something that I think is so critical as part of, you get older. And I know a lot of people talk about financial independence and this whole FIRE method. Financial independent, retire early. Now, for me, I look at it as the time independence to retire early. To me, time is the most valuable resource and asset we have, because you can't make truly more time. Money is something that, you can earn more of. You can't earn more time. Some will say healthy and stuff, but really it's how you use the resource that you have and how you value your time and use it to live best and fullest life. Well, thanks for listening to this episode of Creating Wealth Simplified. As always, feel free to reach out if you have any questions, comments, want more information about our fund. Thanks for listening, and I will catch you on the next one. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.